Most people try to invest while their money is literally on fire. They're buying stocks while 20% interest is eating them alive in the background. That's not investing. That's financial self-sabotage. Quick question for you. Would you invest in a fund that guarantees a negative 22% return? Of course not, right? Well, you might already be doing it. The problem is, nobody teaches the correct order of money. People jump straight to crypto ETFs, day trading all, the fun, exciting stuff, without building a solid financial base first. It's like putting solar panels on a house that doesn't even have a roof. It makes no sense. Or imagine upgrading the stereo in your car while the engine is completely missing. That's what most people's finances look like. The result is constant stress, incredibly slow growth, and years of wasted compounding potential. The real tragedy here isn't making a bad investment. It's investing completely out of sequence. Let's look at a few examples. First, having no emergency buffer. One unexpected bill hits. Your car breaks down, you have a medical expense, or maybe there's a hiccup at your job, and boom, you are forced to sell your investments at the absolute worst possible moment, probably at a loss. That isn't bad luck. That's the direct result of a missing safety net. It's a fact that most Americans couldn't handle a $1,000 surprise expense without panicking. That's not just a finance problem. That's a sleep problem. You simply can't build real wealth when you're reliving one minor accident away from a total disaster. Example number 2. Investing while carrying high-interest debt. This is the silent killer of wealth. Credit cards charging 18, 20, even 25% interest are mathematically way more powerful than your investments. Every single dollar you invest while carrying that kind of debt is like trying to run uphill in deep sand. Beating the market is hard enough as it is, but beating a guaranteed high-interest debt is practically impossible. Here, some mind shift for you. Paying off a 22% debt is the equivalent of getting a 22% guaranteed return on your money. That crushes almost any realistic investment portfolio you could build. And example number 3, ignoring free money from your employer. Your employer's retirement match program is the closest thing to a financial cheat code in the real world. It's an instant return on your money. You put in $1 and they instantly double it. If an offer like that existed on Wall Street, hedge funds would be rioting in the streets to get a piece of it. Yet, millions of people just ignore it every single year. That's not just a missed opportunity. That's like walking past a pile of free cash on the sidewalk and not even bothering to pick it up. So here's the correct order. It's not flashy. It's not going to go viral on social media, but it is brutally effective. Step 1, build a starter emergency fund. It can be small at first. Think of it as a survival buffer, your psychological armor against life's surprises. Step 2, destroy your high-interest debt. Anything with an interest rate over about 8% is a major financial leak in your boat. You have to seal it, and seal it fast. Step 3, capture your full employer match. Never, ever leave free money on the table. Step 4 is to max out your tax-advantaged accounts. This means your IRA, your 401k, and your HSA if you have one available. These aren't just savings accounts. They are powerful tax shields. See, taxes will quietly steal more of your wealth over your lifetime than a few bad investments ever could. Optimizing for taxes is a form of investing in itself. And then, step 5, and only after you've done all the previous steps is when you start taxable investing. Now you can build aggressively with confidence because your financial base is stable. And stable money always grows faster in the long run. So let's do a quick recap. Emergency fund first, then kill high-interest debt. Then get your full employer match. Then max out your tax shelters, and finally, invest. The order you do things in matters way more than picking the perfect stock. A smart sequence will always beat the hype. Remember, most people chase returns. We build systems. And systems are what win. If this video changed how you think about money, please subscribe. We're all about building smarter wealth here, not just louder wealth. And I want to hear from you. What step are you stuck on right now? Is it the emergency fund? The debt? Maybe you feel like you started investing too early? Drop it in the comments below. I read every single one. Thanks for watching.